Good day, everybody. Brian here from quantlabsnet.com. We're going to talk about, with my face here, talk about HFT algorithms from simple to advanced techniques. Later in this video, I'm going to talk about and show you a proposed menu structure of what high frequency trading firms will use for their institutional trading platforms across their enterprise and what they do, what they look for. This goes right down to all the different types of strategies, along with options and futures. Let's get to it. So, we are talking about what is HFT. Um, Basically, it's a topic that often sparks curiosity, confusion, and even controversy. So, what is it? Let's break it down. In simple terms, HFT is a type of trading that uses powerful computers and complex algorithms to execute massive number of orders at incredibly high speeds. We're talking milliseconds, even microseconds. That's faster than you can blink. Uh, there are three core principles when it comes to HFT. They include speed, automation, and arbitrage. There's other ones I'll show you in the menuing of this system that I'm looking at, built around my detailed course that I built a few months ago. So basically, regarding the speed, automation, and arbitrage, speed is paramount. HFT firms invest heavily in technology or even the slightest, this is to gain the slightest edge at execution time. It's an arms race. It's a computer arms race, basically, between each firm. Automation means that trades are placed automatically by computer algorithms with minimal human intervention. Arbitrage refers to the practice of exploiting tiny price differences between different markets or exchanges to generate profit. There's other ways as well that's classified as well. I'll go through that later on, and all the different ways through that menuing. Um, HFT has both benefits and drawbacks. One hand, it could increase market liquidity. That's generally what a lot of the firms do, like it or not. It means it's easier to buy and sell assets. It also allows, when there's a gap between the bid and ask price, where market making trading becomes cheaper for all. On the other hand, some argue that this gives an unfair advantage to large institutions and contribute to market volatility, which is where they gain profit. Let's look at the basic building blocks of HFT algorithms. These algorithms are the brains behind the operations. Common types include market making, arbitrage, and momentum. Another one that you seem to forget is hedging. Market making algorithms act like a middleman, constantly posting buy and sell orders to provide liquidity in the market. Imagine a busy street vendor always ready to buy or sell the goods, keeping the flow of commerce going. Arbitrage algorithm identifies and exploits tiny price discrepancies. Think of it like finding a dollar bill on the sidewalk and a quick and easy profit. Momentum trading algorithm tries to capitalize on short-term price trends. It can be also long-term. It's like riding a wave, buying when the price is rising and selling when it falls. So when it comes to data analysis and order execution, this is critical for any HFT algorithm. The algorithm needs to analyze a massive amount of market data in real time to execute trades at lightning speeds. Let's take a step into a more complex world of advanced HFT techniques. These include statistical arbitrage, latency arbitrage, and predictive algorithms, but I'll also show you how I could see it like what any other institution does. So Statistical arbitrage uses complex statistical models to identify temporary price anomalies. Latency arbitrage exploits delays in market data feeds to gain an edge. Predictive algorithms, obviously using AI or machine learning techniques, try to forecast price future movements based on historical data and market trends. There are advanced techniques that are highly sophisticated and often involve significant risk, especially if there's leverage. They also raise ethical and regulatory concerns, particularly regarding fairness and market manipulation. HFT impact on markets is the subject of much debate. Some argue that it improves liquidity and price discovery, while others worry about its potential to increase volatility and create an uneven playing field. Controversies surrounding HFT involves accusations of market manipulation, unfair advantage. It's a complex issue with no easy answer. What's the future of HFT? It's unlikely to continue to evolve with advancements in technology and algorithms. There's an understanding needed to become increasingly important for all market participants, from individual investors to institutional traders. As I said, we are individuals who can trade like institutional traders if you just hang on to what I'm about to show you. Key takeaway HFT is high speed, automated form of trading using these complex algorithms. Its benefits both, and it has its drawbacks for financial markets. Its future is likely to be shaped by technology advancements and regulatory changes. What do you think about HFT? Let me know in the comments below. And don't forget to like it and subscribe for more videos on finance and investing. I've also included some helpful resources as well, and I'm about to show you something that I believe can be used to give you edge from an institutional point of view. Thanks for watching thus far. Hello, everybody. Welcome to our next section of our little prototype of a menuing system that I'm looking at for a ready-to-go institutional trading platform. This will be for my own self needs, but I wanted to introduce you to this to show you all the different considerations when it comes to this type of trading, research, and strategy development. Most importantly, I've run a little survey. This survey is geared towards institutional operators, those that own trading firms or that want to get into it and want to be able to trade like an HFT firm, high frequency trading firm, with all the tools available to you that does the calculating and charting and the like. Again, from an institutional point of view, and this focuses on all futures and option derivative product that's available out there in the US, but does not include individual stocks. Okay, let's start taking a look at it. The more important thing are the various tools that are available in this. So you can see it's quite lengthy. This all comes from a course that I've developed 2 months ago and includes all the coding that's ready to go and has to be plugged together using C++ on the back end and JavaScript on the front end. I could easily turn this into an API backend for people to subscribe to. I could also make this into a completely independent website and the like. But let me show you what's in it. So the first big area is HFT research, trading idea research. So if you come under here, you'll see we cover things like treasury bond, euro dollar, bond quote to dollar, and euro future quote to implied interest. One thing I want you to take away for this is for futures trading. These are not small contracts. These are 1 million plus. And as I said, the key word here is institutional. So this is who it's geared towards, is institutional that can afford to trade in these very expensive products. unless, of course, it's a mini and whatnot, but that's where I'd go for my own trading. So then, of course, we go into the different types of utilities that I'm considering. Yield curve, where you could visualize it for potential recession forecasting, cost to carry calculator for real big trades, specifically on things like yen. We also like to measure and compare for currency purposes, for different currency purposes to measure inflation and the like, to know what kind of currency to trade in a futures contract, be it euro, euro dollar, British pound, New Zealand, Australian dollar, or even Japanese yen and the like. We also have to look and measure if we were to start looking at a complete portfolio where we would want to look at things like a risk return frontier and showing an indifference curve to show the type of relationship here. Another thing that we need to look at are the different types of price change scenarios that go on within the futures and options market. So, another thing a lot of people may not quite understand is the intemporal uh, price relationship among many different products within the futures and options markets. For a good example of that, we could look at the market indices like S&P and the Nasdaq. Another area we could look at is arbitrage within the overall commodity market space. So let's start to look at the future contracts and the different scenarios that we have. We can look at general profit loss on as many future contracts that are out there that we could trade. As specific examples, we could look at a euro dollar contract, measuring the LIBOR, for instance, and including the more important that most trade that nobody at the retail level will ever factor, and I've done a webinar on it, is notional value. We could also measure just plain euro contract using a calculator. We could look at yen future contracts with the calculation and potential profit with yen. We can also, as I said, look at the cost to carry for treasury bond, where we can measure things like opportunity cost, coupons, and net cost of carry. We can also look at a general future and short P&L calculation. We can also do the same thing with the yen future using a long short P&L. We can also look at general future yen trades. And as another example, in the agricultural space, why not do simplified corn futures as well? This is where it gets very interesting in the options market. You can see here, most of the opportunity will lie in options. So what we're looking at are the calls and put options. We could use different examples, for instance, things like call option on a crude oil future, simulate a buyer and sell perspective of a call option, the crude oil option scenario. We can understand and look at the concepts of hedging and modern portfolio theory. We can also understand buyer seller perspectives for a call option on, again, crude oil. And again, these are all static examples that can be adapted and modified. Core option concepts, we could look at concepts of time value, time decay, data. We could look at put option premium, crude oil put option, analyze crude oil put option, analyzing time value of an option, delta for options, explaining delta in options, all the different techniques of that, intrinsic value and time value for an example of cotton call options, intrinsic value time for treasury bond put options, intrinsic value on a put option, calculating total time of a yen option, resulting from a soybean example, hypothetical arbitrage scenario. Again, we've already talked about simple arbitrage. We can look at all the components that go into an arbitrage position. We can model out the components of an arbitrage position strategy with a put option or a call option. This right here is the core of how do you know if you have market efficiency or not. Here you can use a component of an arbitrage strategy to measure put call parity. We can visualize the equilibrium of the premium showing the shifting demand and supply prices. We can visualize impact of time decay on call options, highlighting various options. So much data here. Visualizing delta gamma option price lines with a tangent line illustration, evaluating different put options. That's the options. Everyone's going to argue all about technical analysis. Technical analysis is such a small piece of this entire puzzle. There's really only two important indicators that are useful. Something like a simple moving average or some form of an oscillator, typically something like a relative strength indicator. So I'm going to go on and use things that other people are not talking about in the world of futures and options trading that a lot of the firms use, namely, obviously, high frequency trading shops. So here they measure on things like basis widening, an example of a farm rancher using long short after hedging, measuring a long short P&L after a future contract, calculating the number of contracts to use in hedging, using basis change on hedging, measuring hedge ratio, using arbitrage hedging, operational hedging, hedging interest against treasury, hedge strategy against the euro dollar, hedging for commercial paper, for instance, measuring, I don't know, real estate deals. This is when the quant kicks in. This is when the heavy, heavy quant math kicks in. Okay. There's a basic, well, I shouldn't say basic. It's not complicated, but it's doable. As I said, I've got all the code available, ready to go. Put in the parameters, you get the outputs. So here, using the quantitative techniques, we could measure things within a framework of hedging. We can hedge to evaluate portfolio risk. This is a big thing that a lot of the institutional firms do. We look at hedging for diversification as a strategy, allowing you to calculate things like portfolio return and the like. And here you can find the optimal hedge ratio, H star, and interpret the impact of various types of correlation. Here we can talk about calculating a portfolio return by combining both a cash and a futures position. Here we can talk about calculating a portfolio return based on different hedge ratios and explaining risk return, real risk return trade off as quantitatively measured between an unhedged, fully hedged, and an optimally hedged set of positions. So we can develop, looking at this, we can develop new strategies and new trading ideas being able to do this. This is how we measure this. Then we can also look at, lastly, among hedging here, how to measure different components of a portfolio to calculate the hedge portfolio return to evaluate portfolio risk using variance. Now, again, I want to remind you this would be presented in a JavaScript front end, measured and calculated via a C++ backend. These are just the starting points. One of the key areas that's never talked about are payoff diagrams. Payoff diagrams where we compare a long future position and a long call option. We can also use the payoff diagram. Again, these are only examples to showcase this. A yen put option, payoff diagram for a long call option on a T-bond future. We can also, which is more the most important point here, where everyone asks, well, how do you measure this and how do you measure that? It's all about trading within a trading zone, a golden trading zone. And this is how we're able to measure the break even point for not just T-bond call options, but a breaking even point for any type of option we want to use. We can use a payoff diagram for hedging put options as well. That's just some of the examples. Everyone seems to forget about the important Black-Scholes model. So here we can talk about theoretical call put options of Anything, as I said, but in this case, call crude oil futures using Black-Scholes. We can also use that for calculating delta call options, and we can also, more importantly, use it to calculate different types of Greeks, delta, gamma, theta, and vega, again for options using Black-Scholes model. Out of that, we're able to combine different types of strategies. Okay, different strategies measuring all these different tools available where we can evaluate scenarios, for instance, a price decline that protects against downside risk and price increase. This is what it's about, to be able to measure that, quantify it, and then build a system around it. So another scenario we could use this for is evaluating two scenarios of a put options, one with a high strike price, one offering protection, and another one with a low strike price, allowing for greater upside. Again, I put up a video last week on it. Nobody seems to want to watch it. Personally, it doesn't bother me, but this is how you make money in the world of trading using these types of setups. So also we can construct payoff diagrams to measure long cash positions and a put option with a payoff diagram. Also, we can measure a way to visualize hedging strategies to focus on long cash positions and put options. There's different techniques here, and again, these are just examples of what's capable and future things. The ultimate thing we want to be able to do is to be able to develop a self-adapting trading system. This is not a bot. This is not something simple. You can see how long it takes just for me to get to this point. But when you can develop something that's self-adapting, being able to do this 24/7, or at least in the futures and option hours of the US markets, you got something very powerful here. If you want to know more about what I do, I would strongly recommend you go to my website at quantlabsnet.com, which is quantlabsnet.com, and you can go under the top here to learn more, to get basically access to our limited time ebook on C++ and HFT programming, how these firms measure all this stuff using C++, and along with other techniques. As I said before, this comes from all the codes available outside of a complete trading system. You can get introduced to this for a very low price. Okay, 3-hour video just to talk about what are options and futures. You can watch it, and you can watch a video here to understand that. And then from there, if you're interested, you can go through all the theoretical to understand what I just presented here. And maybe, just maybe, I might have a trading system at the end of all of this. This is a very exhausting process, but this is how the HFT firms do it. And if you're too lazy to do it, what can I tell you? Don't bother. The other thing is, I'm only gearing this towards those folks that are paying 3 digits per month, because you are out there. You are part of my audience. And right now, I want to talk to you to see if this sort of thing measures up to what you need. Again, if you want to know more, I'll put my Como form link on there. Don't worry, it's not going to point you to spam. This enables you to talk to me one-on-one, asking these questions so I can understand your situation and to see if this sort of thing can help you increase, build, and boost your profit consistently and safely using downside risk as as long as well as all the other techniques that I've shown you, just different examples. Thank you for watching. Have a good day.